you now have Chair Powell and the Fed saying things like the increase in long-dated U.S. Treasury yields and the rise in U.S. term premium and all that is doing the tightening work for us, right? You hear that narrative, right? Okay, so if that's the case, then that's another way of the Fed essentially saying, knowingly or otherwise, that the Bank of Japan is doing the tightening for the Fed. Because if the Bank of Japan was behind that move higher, and that move higher is doing the tightening for the Fed, then the Bank of Japan is doing the tightening for the Fed. So does that mean that Fed and other central banks that were now on pause, ECB, Bank of England, so on and so forth, is global monetary tightening policy now being run out of Tokyo while everyone else is on hold, on pause? I mean, it's not an insane thought. And if that is the case, then my God, do we need to watch the Bank of Japan more than ever before? And furthermore, if that is the case too, the policy is now in the hands of a central bank that is in the middle of an experiment of unwinding an experiment, or who the hell knows what they're doing with this experiment, but they're purposely injecting uncertainty clarity. There's no forward guidance. There's no dot plots. There's unlike every other central bank who tries to not surprise markets and give guidance. Now, central bank policy direction is being guided out of the one central bank that is not only the weirdo outlier, but it is the most opaque in terms of the majors out there.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Weston Nakamura, who's the founder of Across the Spread, which is like a really cool platform where Weston shares his thoughts on what's happening in the world and specifically Asia. So, Weston, thanks so much for coming on the podcast today.
Hello, Anthony San. Well, thanks for having me back.
I haven't been called that for a while since I was learning Japanese in junior school. But thanks so much for coming on. But yeah, I've really enjoyed your thoughts and your opinions that you have, I guess, on what's happening in Asia and the BOJ. But from your perspective, what are you currently seeing, I guess, globally? Because if we look at your bond yields, have continued to go up. That's had quite a large impact on, I guess, the bond market globally. So what are you currently seeing there?
Regarding the bond markets?
Yep.
Yeah, sure. So you might have noticed bond yields have been going upwards over the last 3 months or so, specifically starting around, July 28th of 2023 is when that happened. So basically if you just look at a year-to-date chart of 10-year US Treasuries, the risk-free rate, the most important price in the world, the chart looks like the chart is basically up and to the right. It's rising. However, in the first half of the year, Treasury yields basically just would go up to about a little over 4%, some kind of almost arbitrary level. It's not like 4%, right on the dot. And then they would bounce back down. They would just, reverse trend. And then that happened twice, right? But then the third time it happened, those buyers at that level didn't come in to reverse the market. And instead, Treasury yields broke out and they went up to 5%. And what was behind that? Well, when let's break that apart into two separate two separate sort of things. One is the breakout itself, because indeed it was a breakout. Because like I said, this was a move that had been testing these levels previously and had then subsequently broken out from. So it was a breakout. And then let's also talk about, separate from that, the sustained upward move for the 3 months that had, followed. Okay. The breakout move itself, when that happened, there was 3 general narratives being put out there. One, Fitch, the ratings agency, downgraded the United States debt from investment grade all the way down to investment grade. Okay, that's reason number 1. Reason number 2, there was the announcement made that U.S. Treasury issuance, supply of U.S. Treasuries was greater than had expected. And expected by who? Expected by 20 managing directors in financial centers around the world, 20 people at primary dealer banks. Okay. And number 3, the Bank of Japan. Something about the Bank of Japan. Okay, those are 3 reasons. Now, I won't brush aside the first two. I think that those are legitimate catalysts. But those, all 3 of them are, yeah, they contributed to a breakout move. That was what was different that time. That sellers overpowered buyers to get treasury yields to break out well above 4. But then the sustained move thereafter, those first 2 things, they don't matter anymore because those are like announcement defined catalyst. Something happens in markets that makes markets suddenly, efficiently, quickly reprice, whether that's a spike in bond yields, a 50% drop in a stock, whatever it is. But they don't like last. That thing doesn't just keep lasting and lasting over and get priced in over the course of 3 months on the same headline. Yet that's all that people were talking about. People forgot about Fitch, as they should. It's the least important of the 3 majors, or as I like to call it, Moody's, S&P Global, and then as the big 2 and Fitch, basically. All right, so everyone kind of forgot about that. The treasury issuance thing was the only thing that survived because the Bank of Japan story just faded out of view too. The Bank of Japan story is the most significant one out of all 3 of them. Surprise, surprise. But even if you didn't know about the Bank of Japan thing, I think that it's incredibly stupid for people to just accept this narrative that headline, that one announcement of increased supply of issuance, which by the way came in lower than expected subsequently, but for that to it doesn't make sense in terms of market price action. Like things like that don't get reflected in markets as like this kind of almost linear line that just keeps going up and up and up. Like how long does this take for bond fund managers to realize and like to start selling? It was like one after another, like saying like reacting 6 weeks after the fact on this like increased treasury issues. So sorry, I had to just vent about that. You as you know, Anthony, you're like my therapist. I have to vent about like my complaints about financial market nonsense commentary out there. All right, let's talk about the Bank of Japan. What is the Bank of Japan currently doing? They are currently undergoing a significant shift, and that means it's a significant shift for global markets writ large. Why is that? Because the Bank of Japan and the JGB market is the world's duration anchor. World's duration anchor meaning that the Bank of Japan and Japan as a whole, Japan is the largest foreign fixed income investor in the world, deploying trillions overseas. They are in your bond market, wherever you may be, okay, in your sovereign bond market, likely. They are the largest foreign holder of U.S. treasuries, as well as in France, as well as in Australia and some other sovereigns as well. They're the largest foreign holders. So what happens in the monetary policy of Japan domestically matters for foreign fixed income, for international global fixed income. So at the very end of July, the Bank of Japan shocked markets by suddenly not just lifting the band of yield curve control, the upper band, the cap on yields from 50 basis points to 100, but they did it in a way that they changed the fundamental framework of yield curve control and how it operates, with more flexibility. And this is a term that I've been calling yield curve control, YCCC. Essentially, what they're trying to do and what they've been doing and are currently still doing is under YCCC, yield curve control, they are attempting to reclaim their yield curve control program back out of the hands of markets and into their own hands. Okay, because up until then, they were not able to do that. Yield curve control became something that they had been imprisoned by. They would set a specific yield level, a cap on yields, and they would have to defend it to the death. And defend it to the death, they did at the expense of the currency, expense of a lot, right? And so they needed to find a way to introduce what they call flexibility or optionality, but what I call uncertainty and sort of undoing of precedents and procedure. And they had to do that. Their flexibility comes at the expense of us market participants understanding of what the policy is. So they're injecting uncertainty purposely into the markets of what they're going to do. They're moving the goalposts, and we don't know where the goalposts are, let alone if they even exist anymore. Okay, that's what yield curve control is all about. That began in July. So back to that U.S. Treasury long end, sort of rising explanation. The trigger catalyst, fine. I'll give you Fitch. I'll give you the issuance of more Treasury bills, notes, and bonds than expected. But also, I will also say that those two things are not direct market events in and of themselves. They can influence people in markets to sell off treasuries, but the Bank of Japan one, okay, in which the Bank of Japan is like removing the cap or moving the cap from 50 basis points where yields were pressed up against and doubling it suddenly, that's the only actual direct market thing catalyst out of those two. So when you suddenly have JGB yields that are now suddenly allowed to trade 2x higher than what they were, yields 2x higher, then JGB yields are going to jump, and they did immediately. They blew through the 50 handle into the 60 basis points in like a matter of like days. And what happened to long 10-year U.S. Treasury yields and long end rates around the world? They jumped subsequently as well. Okay, so that initial jump that was triggered by all three, let's just say equally. But then the sustained move thereafter, again, those first two, they don't continue to get priced in. But that was basically almost entirely the Bank of Japan, because from that point forward for the next 3 months, this almost orderly rise that you see in 10-year U.S. Treasury yields, if you put a chart of 10-year JGB yields right on top of that, they are basically kind of in lockstep. And the Bank of Japan has been managing this slow grind higher and higher with various tools that they have at their disposal, and using this cloud of uncertainty that they've just injected into markets, where markets are walking on eggshells. They don't know where the Bank of Japan is going to step in, at what point, how, at what level, what notional amount, all of that, these unscheduled bond buying operations and so on and so forth. And that's how they were able to just get yields to climb ever slightly higher and higher and higher. Okay, so if you're wondering what happened to the bond markets, the risk-free rate over the last 3 months, there's never a single reason for any market move, let alone one in the U.S. Treasuries. But the proportion of like coverage and attention that's given to the Bank of Japan as the driver of that versus the nonsense that I just mentioned before is astounding. So I just wanted to first lay that out there first and foremost.
Okay, great. Thanks for going over that. It's fascinating to hear. So if I'm not mistaken, previously the BOJ sort of had a level of 50 basis points. That was sort of their yield control, or at least recently. And then, as you said, they pushed up to 100. And now there's, as you said, there's ambiguity. They're saying that there's a range apparently, but they're not going to tell us the range. So is that sort of what's happening? So that's the way that they're sort of trying to unwind this yield control slowly.
Yeah. So what I just went over basically was what happened at the very end of July, and then the 3 months after. And then we just had a Bank of Japan meeting at the end of October. At the end of October, they announced another policy change, but it is in line with the broader theme of yield curve control, of injecting even further policy uncertainty, purposely further policy uncertainty and ambiguity, and kind of rewriting rules and reordering, of things, and shuffling up the Etch-a-Sketch board of prior precedents to reclaim the policy back. And so what they did in October was, now instead of having an explicit cap on where 10-year JGB yields can trade up to, that cap is no longer there. There is no more explicit cap. So for the first time in the post-QE era, the world is finally, for the first time, without an explicit central bank put option. So that in itself is like historic and significant. Okay. Yes, we've had one this entire time, whether or not you realize it. Right. Hence, 10-year U.S. Treasuries year to date, like for the first half, like I said, bouncing off of 4%, a little bit higher than and off and on again, because cap yields were capped right there at JGBs. We are no longer without that, and not just that, but again, we just don't know if or where the next sort of level of tolerance is. Now, that's not to say that the Bank of Japan is no longer easing, or is no longer buying bonds, or no longer trying to control the yield curve. That's not at all what I'm saying. They clearly still are. What I'm saying is that there's no explicit cap, and that is still a very big deal, and that is still significant. Okay. What they've done now is, so if you just actually go back to a little bit less than a year ago, December of 2022, that's when they first lifted the yield curve control bans. Surprisingly, this is under Governor Kuroda, the previous governor of the Bank of Japan, from 25 basis points to 50 basis points. And 25 is where they held firm throughout 2022. No, come hell or high water, they were not going to budge on that 25 basis points cap, even though 10-year U.S. Treasury yields started the year at like 1.5% or something like that. It ended up in with a 4 handle. Rates, global bond markets, global central banks everywhere ripping rates by hundreds basis points higher. Bank of Japan stood firm at 25 basis points. The very, very last meeting, they moved that upper band to 50 basis points. They did that in order to improve bond market functioning, because when they were capping that 10-year US or that 10-year JGB yield, there was so much concentrated buying specifically at that 10-year tenor that you got this very messed up looking JGB yield curve, this infamous kink, in which 8 and 9-year JGB yields would yield higher than the 10-year JGB yield and higher than the 10-year JGB yield cap. Okay, so it was extremely messed up. So they thought if they just allowed the 10-year JGB yield to trade higher than that current cap, that would smoothen out the yield curve, and that would allow for improved bond market functioning. So that's the reason that they did it. They didn't do it for like inflation reasons or anything like that. That's why they did it. That was a massive backfire on them, because first of all, it made that bond market functioning and that kink even worse. But what it also did was it awakened this like giant of massive selling of JGBs from market participants, especially from the forward community, thinking that this was the beginning of the end of the Bank of Japan on a like tightening cycle and all of that. And so they thought that from here on out, every single meeting going forward, there's just going to be another like raise, just the same way as the Fed would go on a rate hiking cycle. They just go in succession, one after another, another after another. But they were saying at the time in December 2022, no, this is not policy tightening. This is for market functioning purposes only. Markets didn't listen to them. And eventually what happened was in that following month, in January, when yields just moved right up to that next 50 basis point that new upper limit, the Bank of Japan found themselves having to defend that new level, which obviously they can't move once they just moved it there. They can't capitulate on. They defended that level to the death, and to the point where the Bank of Japan ended up buying, in other words, foreigners ended up selling, and Bank of Japan ended up buying about $180 billion notional worth of JGBs in the month of January of this year. Okay, to put that in perspective, $180 billion worth of buying worth of QE by the Bank of Japan. The Fed at peak QE was doing $120 billion of QE in a month. The Bank of Japan at $180 billion worth of QE in January was doing 50% more QE than the Fed was doing at peak Fed QE. And they did that this January in the midst of a global tightening cycle. So you tell me if that December rate hike was the start of a tightening cycle, or like a not easing. Okay, sounds to me like it's record easing, and it was. So, but what they learned then, and what they kind of got like a very expensive lesson in that's affecting policy today in the Bank of Japan, is they realized that like they can't move that upper yield curve control limit no matter what level it is, because the markets will just keep just jumping up to that next level immediately, and they'll have to find themselves to continue to defend it. They needed to reassert control over yield curve control. So that's why they're getting more and more ambiguous. So that's what they did that's what the July shift was all about, right? They didn't necessarily move the upper band target from 50 basis points to 100 basis points. They just dissolved that 50 basis points into a reference rate, whatever the hell that means. And they just put that 1% upper limit there just for good measure. They didn't think that it would get there. It got there. And then once it got there, basically on the eve of the latest October Bank of Japan meeting on Halloween, 1 or 2 days before that, JGB yields were at like 96, 97 basis points, or basically right at that level. And so what did they do? They removed it altogether. Significant, because what they're doing is, to put it simply, if you put a level out there, a red line in the sand, you're going to have to defend that. So if you don't want to defend that, just get rid of the line. And that's what they did. Now, what's come from that, like the interpretations, is just like spanning the full spectrum, and it still is, to a point where, like, and this is purposely what they're trying to get. They're trying to get confusion and disagreements out of market participants, to the point where you have people who were hawkish going, with a hawkish view going into this Bank of Japan meeting, thinking that they were going to raise that upper cap from 1% to 1.5%. They saw this as a dovish disappointment, when someone like me, who previously has been on record and saying, like, they're never just going to rip off the band-aid of yield curve control. They ripped off the band-aid of yield curve control, right? So it's almost like I'm disagreeing with the Hawks, saying that, no, like, you were right and then some, and they're saying, like, no, this is a disappointment. But that back and forth, that's just one example of the overall sort of theme of policy disagreements and uncertainty and non-clarity. And by doing that, because we have no idea where goalposts are, if they exist, all this like fog that they've injected, they've reclaimed or attempted to reclaim control over yield curve control. So that's what happened since. And going forward, I'm going to assume that they're not going to be any more clear.
Okay. So do you assume it's going to sort of follow a similar trends where, yields are going to continue to go up, but you're not sure?
No idea. No idea. I have no idea. This is exactly what they're trying to do. The point is, though, that me saying I have no idea, that puts me actually ahead of most of everyone else who has an idea. Based on the October blah, 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 we believe, we at, some whatever too big to fail, too big to succeed bank economist, we believe that, they will do X, Y, and Z by this time, the X, Y, and Z by this time. They're laying this whole thing out. The point is that you are supposed to not know. Not like know more. So you already have like a completely, you're wrong in your approach to begin with. And if you're right, it's out of luck, but yeah, and so as far as I'm concerned, I can make the argument. I don't think that this is the case, but I can certainly make the argument for people that yield curve control is by and large dead and over with, because there's no upper cap anymore. Now, since then, they have stepped in to offer to buy JGBs, not at a fixed rate, unlimited manner, but nonetheless, they have done that, and yields have backed off since. There's a confluence of other factors as well. There's the FOMC that came shortly after, like 24 hours later, which was, inline FOMC anyway. There was, I think there was 100% probability of a no change, and that's exactly what they got and all that. But what this is, the bigger kind of message that I want to kind of deliver here is how it relates to people around the world and sort of other markets and the U.S. Treasury market, right? So I talked about just now how the Bank of Japan essentially was a primary catalyst in getting yields to break out at the end of July, and then sustain that move higher all the way up from 4% to 5% on 10-year U.S. Treasury yields for the 3 months thereafter, right? That move, if indeed that was the Bank of Japan driven, okay, you now have Chair Powell and the Fed saying things like the increase in long-dated U.S. Treasury yields and the rise in U.S. term premium and all that is doing the tightening work for us, right? You hear that narrative, right? Okay, so if that's the case, then that's another way of the Fed essentially saying, knowingly or otherwise, that the Bank of Japan is doing the tightening for the Fed. Because if the Bank of Japan was behind that move higher, and that move higher is doing the tightening for the Fed, then the Bank of Japan is doing the tightening for the Fed. So does that mean that Fed and other, central banks that were now on pause, ECB, Bank of England, so on and so forth, is global monetary tightening policy now being run out of Tokyo while everyone else is on hold, on pause? I mean, it's not it's not an insane thought. And if that is the case, then my God, do we need to watch the Bank of Japan more than ever before? And furthermore, if that is the case too, policy is now in the hands of a central bank that is in the middle of an experiment of unwinding an experiment, or who the hell knows what they're doing with this experiment, but they're purposely injecting uncertainty clarity. There's no forward guidance. There's no dot plots. There's like, unlike every other central bank who tries to not surprise the market and give guidance, now central bank policy direction is being guided out of the one central bank that is not only the weirdo outlier, but it is the most opaque in terms of, you know, the majors out there.
Yep. So can you explain, I guess, the correlation? So as you said, even though yields are quite low in the BOJs, they have increased quite a lot, and that's had an impact in the US. Can you explain maybe why that happens?
Why is it that when 10-year JGB yields rise, that global yields rise?
Yep, correct. Even though, because I guess it does make sense, but they are so much lower than all the other bond yields globally.
Yeah, they are. Yeah, and to your point, that economically makes no sense, right? Japan is the most indebted country in the world by far. Yet the Japanese government gets to borrow for 10 years out at less than 1%, while the risk-free United States government has to pay 5x that to borrow for a 1 year out. Like, give me a break, right? Like, those are not market prices, market determined prices. The reason though that happens is, I mean, there's several. There's the kind of, you know, the repatriation sort of thing where there's more. If there's a juicy 90 basis points of yields on 10-year JGBs at home, well, the largest foreign fixed income investor in the world will repatriate capital back to Japan to invest domestically, and that way they don't have to take FX risk, especially with hedging costs being so high. Hedging costs are so high, FX hedging costs are so high that it wipes out the entire like nominal yield spread premium between, let's say, the US and Japan. So let's say US 10-year US Treasury yields give you 4% more than 10-year JGB yields. So you would invest overseas into the US, and that's by and large what's been happening. However, you have to hedge your FX, especially if you're like an insurance company or something like that. And the cost of hedging of FX is so astronomically high, it could be like 4% or more. So it could wipe out that entire yield spread premium and then some. So what's the point of investing in, you know, an overseas bond, even if the nominal yield is higher, if hedging costs are going to be, you know, just as high, if not higher? So the repatriation sort of thing, right? And so you get kind of higher yields here would basically entice capital to be sold out of fixed income, you know, foreign fixed income, and thereby yields go higher there. That's like, yeah, that's like a, you know, the common sort of theory that's given. That's not really mechanically how it would work though. Like the reason that you see from the end of July to, you know, end of October, like lockstep movements in JGB 10s and US Treasury 10s and so on and so forth. That really is more of, I think, just a systematic flows sort of thing. Because trading volumes on treasuries and stuff like that, it's not like they were, you know, robust during that period. Like a lot of people were like active managers were kind of hands off. So that's just a matter of no different from you know, the Nikkei and the ASX, like the, you know, the Asia developed market equity indices were up because S&P had a strong day the day before, right? And then European the DAX, Euro stocks, you know, UK FTSE, whatever, would also have like a strong day. Like fixed income, like government bond markets, DM government bond markets also kind of behave in that same sort of general manner of they're up because they're just globally up or globally down. And if there's no particular specific catalyst other than upward pressure on JGBs naturally, because they don't belong down here at the floor, and this management of the Bank of Japan stepping in and just stopping it, stopping it here and there and here and there, and like letting it slowly rise. That's what's been not just like, you know, guiding the move, but that's what's been suppressing what would have otherwise been what I think a massive like volatile, violent, sharp spike to the upside.
Okay, thanks for explaining that. So it's quite interesting though, because even though the yields in JGBs have gone up, the yen has actually continued to be extremely weak, which I guess you wouldn't think would happen. So, what are your thoughts on that?
So, when was the last time we spoke, Anthony? It's like a year ago, right?
Yeah.
I don't know if it was before or after yen intervention in October of 2022, yen intervention number 2. So, but you're asking an excellent question. Like, if they just basically got rid of the upper ceiling on JGB yields, then JGB yields should spike higher, and therefore they should catch up to like U.S. Treasury yields, and the yield spread should shrink between U.S. and Japan. And as the yield spread shrinks, the USD and JPY rate should be going down because currencies are pair trades, and a lot of that price action is a function of yield spread, nominal yield spread, price action. Okay. Why? So you're asking, why is the Japanese yen getting crushed still, or why is it not getting stronger? The yen, that is. So the straight up answer is I don't know. Here are several reasons why I think is happening. What's happening? So in addition to severely manipulating the JGB market, the Japanese government is also very hands-on and manipulating the currency market, just like G5 protocol says you should do. No, G5 protocol says you should not do that at all. It says markets, determine foreign exchange prices. But last year, around the time when you and I spoke last, the Japanese government, okay, this is not the Bank of Japan, this is the Ministry of Finance, who is in charge of overseeing FX, had on 2 occasions stepped in to directly and unilaterally intervene into FX markets by blasting dollars and buying yen. They did it at the end of September. They did it at the end of October. And when they did it at the end of October, that actually put in not just top tick in USD JPY, but that put in top tick in 10-year US Treasury yields themselves, which had then since reversed its 2022 trend upwards, sharply downwards, and was not seen until this recent rise in yields that was driven by the Bank of Japan. But essentially what happened was that was a massive JPY short squeeze that spilled over cross asset. And it was at 151.96 is where they triggered that. Right now, dollar yen is right around those levels, and markets are very, very now wary and scared of a potential yen intervention that could come at any time. So because they did this like non-economic move in, a non-fundamental action was taken in foreign exchange markets by the Japanese government last year, you're seeing very kind of weird price action and cross asset dispersions that are taking place, such as the yen. It's not really why didn't the yen move, dollar yen move higher, or why did the yen, not strengthen on this, but it's more so the fact that the yen should have actually already been in mid 150s, if not higher, if not for this market created sort of 150-ish self-reinforced cap on dollar yen, thinking that that's the level of intervention. So why didn't it strengthen? Well, it should have. Why did the yen strengthen? Well, it should have been a lot weaker and perhaps strengthened down to this level. Maybe it should have been at 160 or whatever, if not for that, for the markets having already put this fear of yen intervention like coming, in mind, and self-regulating the upside of USD JPY, right? There's also the matter of in the end of July, when they increased yield curve control caps, you saw, why didn't the yen, why didn't USD JPY fall then? Why didn't the yen strengthen at that time? Because yield spreads. The reason that's happening is, once again, because the JGB market and the Bank of Japan is the world's duration anchor. So when they lifted the cap on JGB yields, yeah, JGB yields did go from just under 50 basis points to 60 basis points in a few days, which is a massive, massive move for JGBs. But 10 basis points added to 10-year JGB yields that during that time you had 20-30 basis points added to 10-year US Treasury yields. In other words, JGB yields will go up, but every other yield market will go up. Will have a far greater nominal yield spread surge, and so the nominal yield spreads between Japan and everywhere else will actually widen. And so on that, so that's why you got a move like that happening. If you just look at nominal yield spread differentials between the U.S. and Japan, they drastically, widened after that July move, rather than the other way around, and therefore having dollar yen fall. So that's why that's been happening. But it's also just a matter of like a positioning, and then it's also a matter of, like I said, pure disagreements amongst market participants of what the hell's going on. This is what it is. This is dovish. Sell the yen, right? So
yeah, it's really interesting. So as you're saying, because of the impact that the sort of Bank of Japan has on global yields, the fact that theirs are going up, it's having an impact globally, and it's actually probably almost detrimental for the for the yen as well. So that's really interesting.
No, yeah, because so in the press conference, in this latest press conference from the October Bank of Japan meeting, Governor Ueda had said this a few times, that the recent rise in JGB yields and dollar yen, it's not just a Japan thing, like a weakness of Japan yen or Japanese yen and JGBs. It's also, that's like a U.S. yields matter. Like he's basically blaming the like rise in U.S. yields for both the rise in JGB yields as well as the rise in dollar yen, which is a ridiculous thing to say, because first of all, why are yields in the U.S. like, oh, fine, I'll give you that. Yeah, it is because the yields in the U.S. are rising. But why are yields in the U.S. rising in the first place? It's because you lifted the ban on yield curve control like 3 months prior. But like even like that aside, for him to say that the like JGB yields rising is a function of U.S. yields, okay, but you're the Bank of Japan and you're conducting a program that's literally called yield curve control. Yield curve is in your control, is it not? So you can blame U.S. yields, but you kind of have to, I don't know, look in the mirror and ask that, why are JGB yields going up or down or whatever they may be? Might be Bank of Japan like involved as well, right? So I think that's why I think it's a ridiculous thing to say. But yeah, at the end of the day, though, that's the kind of irony of it, is that if you want to bet on the Bank of Japan to lift their policy, their long end policy rates, not that there is one anymore, going long the yen was not the way to do it, because all it did was just blow out other yields around the world at far more of a vicious pace than JGB yields.
Okay, yeah, it's a fascinating correlation. So if we look at what will happen in the future, do you see global yields continuing to rise? And I guess for that to happen, we'd have to see JGB yields continue to rise. But what are you currently thinking, or are you still unsure about that notion?
Well, the global yields don't have to necessarily rise only because JGB yields are rising. They could rise for any number of reasons. They could rise because Fitch downgrades once again from investment grade to investment grade. Any number of reasons they could do that. But here's what I'll say in terms of being JGB yield driven, or what's the direction? Like, can JGB yields pierce through 1%, which they still haven't yet? First of all, yeah, I think they can. But is this the end of yield curve control? And is the Bank of Japan really going to allow for normalization? Right? Normalization defined as, I guess in Japan's terms, normalization would be allowing market forces to determine where rates are. The answer is no. Like, absolutely not. Okay. They might get rid of, like, they might lift negative rates to not negative, so that the very last Central bank policy is still in negative territory, which is Japan, because ECB and the SNB, Swiss National Bank, has long out of negative territory for some time now. Can they do that? Yeah, they could do that. But in terms of like letting the 10-year GDP yield go to 2%, 3%, 4%, that's not going to happen, because ultimately yield curve control, in my view, is not about inflation or anything like that, or dollar yen levels or anything like that. The purpose of yield curve control, and here's why before I get into purpose of yield control, here's why I'll say why yield curve control has almost nothing to do with like inflation, or the removal of yield curve control, or the hiking of yield curve control bands higher and higher has nothing to do with Japan inflation. Simply because yield curve control has been in place since September of 2016. Okay, so it's been well over half decade that this policy has been in place. Did that cause the current inflation in Japan? It absolutely did not. It did nothing for inflation. It was trying to stoke inflation, supposedly, in Japan, but it clearly didn't work. Why does Japan have inflation right now? Because there's global inflation, for which Japan is not immune from. And with that said, Japan's inflation is far lower than other DM countries' inflation, and at a lag at that. Okay, so this inflation is not caused by Bank Japan policy or yield curve control. So how would tinkering with yield curve control therefore mitigate current Japan's inflation? It wouldn't. It has nothing to do with it. So therefore, why does yield curve control currently exist? Yield curve control exists for the function of keeping government borrowing costs down, pinned down, for the world's most indebted sovereign country in the post-war era, right? And to unprecedented levels. 250, 260% debt to GDP. The Bank of Japan owns over half of the JGB market outstanding, okay, and is setting the price on the long end of the other half. That is what allows for Japan to borrow at 1/5 of the rate that the risk-free United States government does for only 1 year out. Okay, so if the Bank of Japan is increasing or is more like liberalizing the 10-year JGB yield, they can do that, but they can only do that to a certain extent until realities of the fiscal side start to kick in. 1/4 of Japan's current budget, government budget, goes to servicing, debt, like interest and principal on existing debt that was issued with on the floor rates. Okay, within the last 12 months, borrowing costs for the Japanese government on 10-year at the 10-year level have gone up basically fourfold. Okay, Japan is not getting any extra tax revenue from growth or whatever, and it is an increasingly aging society, and the demographics point to less tax receipts and just more government spending going forward. So the Bank of Japan is there to monetize the debt. It's going to have to continue to do so. So what's the upper band on yield curve control cap? I don't know what it is, but what the force is going to be is the Japanese government's very insolvency. The very act of being able to turn the lights on at the Bank of Japan, headquarter building, like that is what is going to cap yields in some form or another. They might not call it yield curve control. They might call it something else. I don't care how they market it and brand it and package it up. But the Bank of Japan, it will be there in some way, shape, or form to continue to purchase government bonds and to thereby directly or indirectly set some sort of, limit as to how high borrowing costs for the Japanese government will be at the long end and at the short end. So that's what I see going forward. And so how does that affect, so if that's the case, and if we are in a higher for longer environment, and if yields on, at the long end on in the US and elsewhere continue to rise, that's dollar yen getting destroyed, or that's dollar yen going higher, or the yen just getting destroyed. So at some point, if that spread really just materially widens out, yeah, you're going to see dollar yen through 150, through 160, and then beyond. So that's basically what I see.
Yeah, it's interesting. I was going to say they probably can't keep yield control going forever and then protect the yen forever. One of them has to go at one point.
Yeah. And here's the thing too, is I'm sure you're aware. So Stan Druckenmiller was recently on TV talking about like Janet Yellen, worst Treasury Secretary ever. What the fuck is she doing? Like she should have issued an insane amount of long dated U.S. Treasuries. Should have had a 50-year Treasury, 100-year like all that when rates were on the floor. 80% of the U.S. public knew to do that. They refinanced their mortgages. They extended their duration. Why did the U.S. government do it? And we missed this one chance and all that. Totally agree. Okay. What I will say to Mr. Druckenmiller, however, though, is look at Japan, though. Okay, not apples to apples, but Japan is currently issuing a shit ton of debt at the long end. So Japan is doing exactly what he's saying Janet Yellen should be doing. And it's not really in a financially better situation by any means at all. Now, of course, there are infinite more differences than similarities, so you can pick that argument apart. I'm just saying like that 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 has already been done, and so many of the options have already been exhausted currently by Japan, to the point where Japan the central bank has to keep buying government debt, period. Okay, perfect example I'll give you is just the other day there was a 10-year JGB auction, and the results of it, the demand wasn't bad. Bid cover ratio wasn't bad. It was actually better than the previous one. And so there were buyers coming in. But that was also because days prior, the Bank of Japan had informed the market via in writing, in policy, that the very next day they'll be stepping into the JGB market to buy 10-year JGBs, to buy like that very issue of JGBs. So that's why you have market participants and primary dealers there to have a strong auction, because they know that they can flip it to the Bank of Japan. If not for that explicit, we're going to be there the next day after the auction, then I'm guessing that there's probably not going to be that as strong of a demand for that particular auction. So that's just like one like microcosm, but like the people buy JGBs or own JGBs, the Japanese institutions and all that, because they know that the Bank of Japan is there, and still they don't really even want to. And there just isn't there's no mathematical way. It's very simple. There's no mathematical way for the Bank of Japan to not do that, unless they want to blow the entire country up on themselves.
Yeah, I don't think they'd be too popular if if that happens. So I'm assuming they're not going to do that. But yeah, Weston, thanks so much for your time today. I really appreciate it. My last question is, what is one message you like people to take away from our conversation?
My one message is very simple. You have to watch not just Asia, not just Japan, but you really have to take a global sort of scope of things. That's why across the spread exists, right? Like when I was in the US recently, and I do this every time I go to the US, but I try to look at market, to see like news or whatever what happened overnight in Asia market. There isn't any coverage on this. And so there's this like massive like information gap, but Asia's like things that are happening out of Asia, especially in Japan in terms of fixed income markets, and especially what's undergoing right now with the Bank of Japan shifting their policy, that is the most significant like market activity that's taking place right now. It's not the Fed, it's not the Treasury issuance, it's not the ECB or anything like that. It's the Bank of Japan that is shifting their policy for the first time in forever, and nobody knows in what way, and they're doing it by further injecting more and more uncertainty and less clarity into markets. That is the whole purpose of it. So despite them doing this less clear sort of thing, you have to watch the JGB market and what the Bank of Japan is doing in order to understand every market everywhere else. Okay, like I say, if you want to understand like 10-year US Treasury market, you have to watch the JGB market in order to understand the 10-year US Treasury yield, right? Or you have to watch the intervention risks and dollar yen in order to understand the broader dollar USD complex, the DXY complex, or whatever it is, right? Even to the equity level, given that Japan had the strongest equity market for the first half of the year, That's all foreign capital. So if you want to know what's going on, if you just watch the Nikkei and the topics, see if foreigners are liquidating, and then if they are, then watch out Nasdaq 100, right? So like this part of the world has come into like significant prominence in terms of global market impact, global market like direct impact, indirect impact, and global market read. And so yeah, so I would suggest that like people just get out of their kind of localized like centers and what the media is telling you is important, and to look eastward.
Great message. Yep. Thanks again for coming on again a year later. I really appreciate that we can put this together. If anyone wanted to find out more about your work, you mentioned Across the Spread. Would that be the best place that people find what you do?
Yep. They could just go to acrossthespread.com, and that's basically, it's just launched. This brand new platform just launched, still in the works. But basically I have like podcast, which is similar to the Market Test podcast, which is what I used to do. I put out written content as well on the intervention, on the Bank of Japan meeting, for example. And just a whole host of other, like a suite of other sort of multimedia content, all original content, but all stemming on like basically market events and developments that are coming out of Asia that affect global markets. This is not for investing into Asia. This is not for Asia-based people. This is for everybody else in the US and Europe and the UK, wherever they may be, who need to know what is going on with their own markets and how it's being impacted out of events and developments out of Asia. So acrossthespread.com is how they can find everything, and follow me at Across the Spread on Twitter or X. I don't know if you say X.
Yeah, I still call it Twitter. I don't get that.
Yeah.
But becoming a boomer, that's the issue. Don't like change. But yeah, thanks again for your time.
Thanks a lot, Anthony, and congrats on all your successes with your channel and your superb guests that you're getting. Very very happy to see your growth.
Thanks for being one of them.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.